Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Today, our webinar title is 5 Essential Skills to Build and Manage a Stock Investment Portfolio. So my name is Shen Chu. I'm the moderator for this session. Before we begin, here's the disclaimer. Whatever we share in this session is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decisions, you're 100% responsible for all your investment risk. Allow me to briefly introduce our speaker today. He is the content creator on kclau.com. He has written over 250 articles on kclau.com, and he's also a weekly webinar host and presenter. He's also the co-founder of DividendVault.com, whereby he manufactured savvy investors who can build dividend-based portfolios independently. And he himself is a dividend investor. He primarily invests for dividend income, and the yield is ranging between 2 to 9% per year. And he's none other than Mr. Ian Tai. So Ian, how are you today?
Hello, Shane. Hello, guys. Good evening to all of you. I'm doing great over here. How about you, Shane?
Yeah, I'm fine as well. So let me just hand over the floor to you.
Yep, sure. And once again, an honor and privilege of mine to be here at Bursa Malaysia to actually share my own personal journey and experience to all of you guys. So I have actually prepared a lot of materials. So I guess, Shane, I will take it away and present my materials. And with that, let me just share with you my screen. And of course, guys, I mean to say, if I ever go too fast, you can actually just post whatever you are not too sure about, post your questions on the Q&A box, all right? Or if you would like to actually interact with me, then just post your comments at the chat box. Okay, so with that, let's just begin. Today, I would like to cover 5 things in this webinar session. So the first one is that I would like to briefly just go through with you what is the fastest way that I believe is the how I say, where for most people they kind of like lose money in the stock market. Okay, so this is actually something that I believe everyone should know when it comes to stock investing. What's the fastest way to lose money in the stock market? Then subsequently, to know how people lose money in the stock market is one thing, but we may also want to know what do smart investors, all right? And I believe that you guys are actually are aspiring investors. Some of you guys are already successful investors. So I guess you guys will actually, it will be very helpful to know what do smart investors think and do differently as compared to the mass market. So this is actually very important. So the first one is to know how people lose money. The second one is to know how smart investors make money. And then the third one is that after you know all these things, right, you kind of like understand that it is actually not so much about what stocks to buy and when to buy and whatnot. It's actually more important to develop ourselves as an investor, because I find that the more I learn, the more I grow as an investor, the more I mature as an investor, the better the returns. Okay. So therefore, the better way to actually invest is to first invest in yourself. Okay. And with that, I'm going to just elaborate to you guys, go through with you very quickly the 5 investing skills, that all of us should level up, including myself, in 2023 and beyond, if we want to actually achieve better results in stock investing. And of course, finally, after I've actually listed down the 5 investing skills, then I will just go through with you each and every single skill, how they can actually help investors to invest better. All right, so with that, let's go into part number 1, where we're going to learn about how most of the people in the stock market lose money. So what's the fastest way to lose money in the stock market? Okay, here is a revelation to all of you guys. So the short answer, okay, which happens to a lot of people, is this. When it comes to stock investing, right, most people actually want to focus on the money, all right? So more specifically, they want to focus on how do you actually achieve or attain returns faster, which means to say how they want to actually how do you actually identify a stock whereby it is priced at $1 and they try to sell it at maybe $1.50, $2 or $3 at the quickest or shortest possible of time. So this is actually the focus of most people, especially for those people who are new to stock investing, or sometimes they have been in the market for 10 or 20 years, but then the focus is still on the money. Well, So that is actually, I believe, one of the fastest way for people to actually lose money in the stock market. I know it's kind of like an oxymoron, or it's kind of like, people actually aim to actually attain fast money from the stock market, fast money from trading stocks in the stock market, but they ended up losing a lot of money. So here, why is that so? Now, let me explain to you this theory. Okay, so this is actually what most of the people are thinking about when it comes to stocks or stock market. They are not necessarily investors, but sometimes they say, oh, I invest in the stock market, but actually they are not exactly investing their money in the stock market. They can be trading, they can be buying shares, they can be selling shares, they can be speculating shares, but definitely they are not investing. So how do I know? Well, if you look at the slide over here, so let me just briefly explain to you what goes through their mind, what goes through their psyche when it comes to the stock market. So let's start out with this. So assuming that today, most of the people, they are actually looking into getting fast money, okay? Fast money, yeah? So in order to actually attain fast money, so let's assume here that this person has no knowledge about stock investing. They have no knowledge. They are quite new to stock investing, okay? And but then the thing is that they want to like attain fast money from the stock market. So for these people, what happens is that they want the money, but they may not want to learn. So they kind of like skip the process of learning how to invest, simply because if they want to spend time learning about stock investing, it's kind of like long, or they perceive it to be a bit long. So therefore, they actually skip the process and they want to get into the action right away. Okay, so they kind of like perceive that learning about stock investing is a very slow process towards wealth. So therefore, they want the action. Okay, so now in Bursa Malaysia, we have about 900 stocks. Okay, so the thing is that without learning how to invest, and you have 900 stocks to choose from in Bursa Malaysia, so how do you actually go about choosing a stock? Well, there are basically two ways that people will go through in order to find their stock. So the first one is that obviously, since they couldn't tell which stock is good, which stock is bad, so they have to rely on two things. Number one, they can actually rely on looking at stock prices, meaning to say they may download apps, they may actually go through forums, they go through social medias and whatnot, and they will actually like how do I say, they will find information about stocks that have risen in prices. Okay, quite logical, simply because they do not know how to actually find good stocks and avoid the bad ones. So therefore, they have to rely on stock prices. So for those people who rely on stock prices, there are also two categories. The first one is that they kind of like just bantai lah, means to say they just see which one that they think they like to invest, they think they like to trade, then they will just trade, or they will actually use technical tools or softwares to actually help them make a better decision. So if for those people who actually look into charts, technical analysis, softwares and all this kind of stuff, then these people are actually traders. They are not exactly investors. Okay, so that's the first category. The second category will be the ones that they are really, really into it to bantai, which means to say they are just there to speculate and gamble. So what happens is that they will seek for recommendations. So typically what they will do is that they will just ask for tips, and these tips they may come from your friends, your family members, gurus, social medias, and so on and so forth. Okay, so they will actually rely on these recommendations in order to find stocks to trade. Okay, so that is actually what they do. So now you see that we have actually, if you think about it, right, this is what people do. A lot of this is what the mass market do. So first and foremost, they are focused on the money. Second thing is that they think that learning is actually too slow. Then because they think that learning is too slow, so what happens is that they need to rely on recommendation, and they have to look at stock prices in order to choose their stocks. So what happened to that is that when stocks are rising, okay, because what they want is actually capital gains. What they want is to buy a stock at $1 and sell it at $2. And the quicker it rises to $2, the better, right? So because they see this as good, so therefore what they will do is that they tend to actually buy, all right? They buy because they fear that they buy because of FOMO, which is the fear of missing out. So which means if a stock is actually rising, something good must have happened to the stock, so therefore they buy. And when stocks are falling, what happens is that since the stock price of a stock is falling, so the stocks can be perceived as, something must have been very wrong with the stock. That's why the stock price is actually dropping. And because of that, they tend to cut loss to protect their capital. So therefore they sell. Okay, so this is actually what happened. So this is actually quite normal, it's actually part and parcel of the game. It's actually pretty normal to find people like this in the stock market. Okay, so that is actually the whole psychological approach for the mass market. So what happened is that when stocks are rising, they buy. So which means to say they tend to buy at a higher price. When stocks are falling, where the stocks are, they are much lower in terms of price and could possibly be a bargain in the stock market, they sell instead of buy, right? Because capital loss is bad. So at the end of the day, what happened to most people is this. So because they did not learn, they don't have any skills when it comes to stock investing. So if you open up their portfolio and you take a look, what happened is that typically, right, the fundamentals of the stocks that they own, they tend to be a bit poorer, all right? Since they want capital gains, so I would say that dividend yields, right, tend to be on the lower side. It can be zero, it can be just 1 or 2%. But then the thing is that this is actually quite negligible because most people who come into the stock market, they may not want to look for dividends. They are more into capital gains because many people say that capital gains seems to be the bigger money than dividend yields. So there's no regards to the fundamentals of the stock. There's no regards to the dividend side of a stock. Okay. And when it comes to capital gains, of course, when you always tend to buy on the higher side, even if the stock actually goes up, your capital gains tend to be lower in terms of percentage. And of course, when you always buy on the high side, and let's say the stock price drop, then the capital loss tend to be higher. Okay, so this is actually what happened in the stock market, especially for the mass market. Okay, so that is actually how most people lose money in the stock market. So that is part one. Now, part number two is that I would like to explain to you guys how most of my friends and myself think and do a little bit differently from the mass market. Okay, so here we go. Now, in contrary to focusing on fast money, me and my friends, like myself, my boss, and the circle of friends that I have, what happened is that when it comes to stocks, right, instead of focusing on buying at $1 and trying to sell it at $2 at the quickest possible time, what we tend to do is to focus on the business, which means to say we are business people who are in the stock market to actually buy shares of good businesses. And what we like to do is to accumulate these shares of good businesses for the long term. So therefore, instead of focusing on the stock price, the movements, the ups and downs in the stock market and whatnot, what happened is that we tend to shift our focus towards the business. Okay, so our primary focus is actually on the business. So if you look at this, so this is actually what goes through our mind when it comes to choosing a stock or when it comes to stock investing. So for us, since our focus is actually on the business, so what happened is that we always want to learn how to assess a good business. We want to actually learn about the business. We want to know what is a good business and what is not a good business, so that if it's a good business, then we tend to keep it. If it's not a good business, we tend to actually avoid it. So for us, we tend to, instead of looking at stock prices and stuff like that, we tend to read a lot, simply because we just want to learn about the business. Okay, and because of that, and because of our obsession or our passion for learning, what happened is that we believe in improving our skill sets when it comes to investing. So when it comes to improving our skill sets, it is basically skill sets that allow us to find better businesses. So therefore, it is again back to our focus or our passion when it comes to the business fundamentals of a stock. So we tend to actually put more focus on that. And when it comes to choosing our investments, what happened is that instead of focusing on stock price movements, buy-sell recommendations from friends and families, or from social media, or even possibly some unsolicited advice from some people, we tend to take ownership and responsibility of our own investment decision. We tend to exercise independent thinking. We tend to actually do our own thing, which means to say we tend to, just do our own study, assess the situation, find ourselves a couple of good stocks, and then we invest in it. And that's it. So we tend to actually exercise independent thinking. We tend to take ownership of our own investment decisions, and we tend to focus on the business fundamentals of a stock. Okay, so when we do that, what happens is this: when stocks are rising, typically speaking, for smart investors, or for the circle of my friends, my boss, and myself, what happens is that when stocks are rising, because the price is actually going on the price is going up. So what happens is that the stocks can actually become more overvalued. And when it becomes more overvalued, we typically don't buy. Okay. So that is really what goes through our mind when it comes to a stock. And when stocks are falling, what happens is that when stocks are falling, then it's kind of like Christmas sales for us as investors, simply because we have already identified the stocks that we want to invest in, and we tend to actually go into the market and buy them. Okay, but there's a difference between stocks that have fallen in stock price. So let's say, for example, the stock market crash and a lot of stocks actually drop. What happens is that we want to separate the ones that are truly bargains and the ones that are not yet undervalued, okay, from that pile of stocks. So the ones that are, the bargains one, then we will actually go in and buy. The ones that are not exactly bargains, they are not exactly a discount, then we actually dismiss them. All right, we kind of like avoid investing into them. So that is actually what we do. So at the end of the day, let's say, for example, if we open up our investment portfolio, so I guess we can actually see similar traits when it comes to how we build, construct, and manage our portfolio. So the first one is this: for investors, we can find that because of our focus, our obsession into business fundamentals, the stocks that we actually kind of like bought and hold tend to be a bit better when it comes to fundamentals. In fact, a lot better when it comes to the fundamentals, because that is actually what we believe in. And because we are focused on the fundamentals, we tend to actually invest in profitable businesses, which means businesses that are income productive, businesses that are making millions and billions regardless of economic condition. In fact, some of these businesses, they still continue to make millions and billions of ringgit, especially during COVID times. They are still making billions of dollars or millions of dollars. So because of that, because of our, our focus and our obsession towards profitability and productivity, therefore we will have higher dividend yields as compared to the mass market. So when it comes to capital gains and losses, here's what happens. Because we tend to buy good stuff at a much undervalued price, what happens is that if really we actually achieve capital gains, the thing is that our capital gains tend to be on the higher side. All right, so yep. So let me just explain what happened here. So for the best market, they tend to buy stocks when they are on the higher side. For investors, we tend to buy a stock when it's undervalued. So mass market buy here, I buy here, or most of the investors buy here. So when the stock price goes up, okay, for the mass market, they only like make this much of capital gains. But for investors, we can actually make this kind of gains. So it's actually quite different. Now, on the flip side, if let's say there's a capital loss situation, so what happened is that, okay, so what happened is that for the mass market, their capital loss tend to be higher, okay? But for investors, since we are advocating buying on the lowest, when it's undervalued, when the stocks are undervalued, so the capital loss tend to be lower. So let me just adjust this. Okay, fantastic. All right. So that is actually the key difference between the mass market and the smarter investors. So what happened is that if really the stock price actually go up, we tend to actually make more in terms of capital gains as compared to the mass market. And if, let's say, the stock price kind of like fall in the future, we tend to have lower capital losses. Not that we are totally immune to capital loss. I do have my fair share of capital loss, but it tends to be lower. Okay, simply because I tend not to overpay for stock. All right. So the question is this. If let's say today you are listening to this and you say, oh, okay, seems like a different idea from what I thought of when it comes to stock investing. I thought that stock investing is about making quick money. I thought that stock investing is about, stock investing is about finding some stocks that are potential. Potential simply means the ones that have the potential to rise quickly and a lot in a short period of time. And you just want to know how to do that. I'm so sorry to tell you that that's not what I personally do. Okay, so if you're looking for that, there are many other places that you can go to actually find all this kind of stuff. But for this webinar, for myself, I don't do that. Okay, so for me, I tend to actually be one who likes to collect, buy, and accumulate shares of good businesses. So my style is a bit more, how would I say? I would like to call it more sustainable. I would like to call it more on the progressive side. Okay, so I tend to build my portfolio, construct it, and manage it in a more sustainable manner. Okay, so that is actually my own style. So the question is, how do you actually make the transition from that to becoming much savior or much smarter as an investor? So with that, we will actually move into part 3, whereby I would like to share with you guys one thing, which is this. A lot of people, they say that which one is actually better an investment? Is it stocks? Is it stocks? Is it properties? Is it crypto? Is it unit trust? Is it ETF? Is it bonds? So what is a good investment? Okay, but after having invested for quite some time, I kind of like noticed this. Actually, in every single investment class, it doesn't matter whether you're investing in stocks, properties, unit trusts, bonds, ETFs, and what, and so on and so forth. There are people who make money in the stock market, and there are people who lose money consistently in the stock market. It is the same for properties. There are people who know how to build wealth in properties. There are people who lose money in properties. There are people who make money in unit trusts. There are people who lose money in unit trusts. There are people who make money in cryptos. There are people who lose money in cryptos, so on and so forth. So what I'm saying here, it is actually, if you think about it, it is actually not what you invest that will make you the money. All right. It is actually the investor. It is actually the investor who, if you know how to make the money, then the money will come. If you do not know how to make the money will not come. It's as simple as that. Okay. So the thing is that, so this is actually why I believe that the investor, which is myself, yourself, all right, the host, and whoever is listening to this today, we are all actually more important a criteria for success than the investments. Okay. So it's actually important for us to actually look upon ourselves, to take responsibility, to actually develop our skill sets as an investor, so that we can actually achieve better results in investing in whatever you want to invest in, be it stocks, properties, unit trusts, bonds, and so on and so forth. Okay, so we are the ones that are more important an ingredient as compared to what should we invest in. Now back to stock investing. So this is actually the key differences that I would like to highlight to you guys. And with that, concurrently also to actually argue the fact that smarter investors, right? Why we should actually become smarter investors. All right. So let's just go through the key differences together. Okay. So we have differences in terms of focus, whereby the mass market, they are into the money, they are into fast money. So therefore, they tend to do things a little bit differently from most of the smarter investors who are actually more business focused. Okay. Now, in terms of duration, since for most people, it's about the quick money, so therefore the duration for them to hold onto a stock will be short term. And for investors, they tend to hold onto a stock for the long term. So because of this mindset, it kind of like influences the character. So for most people, they tend to be impatient and hasty, but for smarter investors, for us, we kind of like think that the stock market, right, is a place where we can build wealth, but it's not so much to build wealth on a very fast pace, but it's kind of like build wealth on a progressive basis. Okay, slow, steady, boring, predictable kind of stuff. But in order to do that, we have to be very patient. So because of that, we tend to make decisions using systems and structure. So we have a criteria. We have a criteria to actually identify good stocks, and we kind of like avoid investing into bad stocks. We know how to calculate the valuation so that we don't overpay for a stock. So that's why we use systems and structure. But for most people, since they are impatient and hasty, so without systems and structures, what happens is that people tend to make their decisions more emotionally and more randomly as they in the stock market. All right, so they tend to make I do not know, maybe decisions which are less logical or illogical, more random, more emotional, very hard to justify why they buy that kind of stock. So they will actually invest in something that they kind of like believe at that moment in time, but exactly what they believe, I'm not too sure. So there are a lot of decisions made which is not so explainable. All right. So this is actually quite normal for the mass market, especially for those people who don't have systems and structures, then they tend to do that. Now, when it comes to learning attitude, since all these things require some skills, so therefore the learning attitude will be higher on this side, whereas for the mass market, it's a bit on the lower side because you want fast money, and they're very impatient, very emotional. So the learning attitude here will be on the lower side. And of course, this is actually the most important criteria that we need to look at. So when losses incurred, now the thing is that rains do fall on both the mass market and the smart investors. Okay, not to say that we learn a lot of stuff, we are immune from capital losses. It doesn't work that way. Okay, it is part and parcel of the game. It is part and parcel of the plan to actually learn how to deal with losses. So when it happens, for smart investors, we tend to learn, reflect, and improve on it. So we kind of like work back on our system and our structure, and we kind of like move forward. We kind of like learn from our mistakes, and we tend to improve on it. But whereas for the mass market, either they have a blaming attitude, which means say maybe they blame the economy, maybe they blame the government, maybe they blame their friends, their spouse, their family members, their relatives, their colleagues, or whatnot. Either they blame. So when you blame, you kind of like do not want to take full responsibility. You kind of like want to play victim of this game. So that is actually not exactly the most helpful behavior, I believe, when it comes to stock investing. Or the other one is that they say, since this is the stock market, it goes up, it comes down. It's quite normal never mind it just happened okay. There's no key lessons to actually learn from this kind of capital losses. So they just remain as they are, all right? So this is actually what I believe the key differences between the two groups of people. Now, for myself, here's what happened to me. Here's what I personally experienced as an investor. Okay, and I believe this experience, if you kind of like copy and paste, if you kind of like follow or refer to it, maybe it will be helpful to your own personal journey towards building a sustainable portfolio. So let's just take a look. So like most people, for me, I did not start off with a lot of money, all right? So because I come from a middle class family, so it's not like I'm given a sizable portfolio to actually manage right at the start, right at the get-go. So So for me, my own personal story is that I started off with little capital. So little capital is one thing, but I realized that apart from capital, because some people say, I don't have money, so don't need to invest. Well, I mean to say, but then I didn't take it as I don't have money or I have little money. I use that as an excuse or a stumbling block towards wanting to invest. So since I don't have capital, um, so I began to actually look for ways to actually raise capital. That's one. But at the same time, also I realized that investing is a skill that I need to learn. I need to pick up because I don't have that sort of skill. I don't have skills, I don't have experience, but I need to start from somewhere. So therefore, I began to actually, I started off as a person who reads, all right, who reads investing books. So that is actually where I started. So I kind of like started off with the skill set. So if I don't have capital, skills, and experience, what happened is that I started off raising capital. I started off raising capital with a job or with some part some gig works and whatnot lah. Okay, and eventually it turned into a business or self-employment, and my income kind of like increased over time as I pursue this journey as a self-employed person, as a business person. All right, so that is actually the capital portion. Whereas for skill sets, I started off as a person who actually reads books. Then from there, one book after another, then I begin to actually craft my own investment plan from my learnings from these books. Subsequently, from there, whatever money I make, I begin to save, and then I started small. I began to build a small little portfolio to actually test out the system, to actually test out the investment plan that I've crafted from my book readings. So which means to say I go from here to here, whereby I have a little bit of capital. I have a little bit of capital, maybe some skills, and then I started to build a small little portfolio, maybe around 10,000 to 20,000 ringgit. Okay, so I started from there. So that 10 to 20,000 ringgit that I invested, it's not so much to actually bring me a lot of wealth, but it is actually very important for me to start somewhere, simply because I needed to actually build on my investment experience. Because after having reading a lot of book and having a little bit of capital, it doesn't make me an investor yet. So what happened is that I need to actually invest in order to build my resume lah, in order to build my experience, gain experience. So that is actually very important. Of course, from there, I began to experience certain things lah. Like for example, I began to receive my first dividend income. Some of the stocks that I bought have increased in stock prices. Some of the stocks that I've bought also have I have also incurred capital losses. So from there, I began to learn. I began to see what is working for me, what is not working for me, and out of which, with that, right, it kind of like shaped me as an investor. So over time, this takes some years to go from here to here. So years later, with more capital, with more skill sets, and with more experience, this is actually where the money is. All right. You can actually, with skills and experience and with capital, that's where my bigger money or the bigger returns of the stock market come. All right. So this is actually where you can actually make better decisions, sharper decisions with better equipment, where you can actually buy into stocks which are fundamentally even better at lower prices or undervalued prices, and then you make bigger gains out of it. So this is actually quite possible, but then the thing is that there's no shortcut to this, because you have to start, because it is actually a journey of years. All right, I would say for most people today, I think it can be, for most people today, with all the learning tools that we have today, it can be shortcut to 2 to 3 years. It can be cut short to 2 to 3 years from going from here as a newbie investor to this stage. It will take around 2 to 3 years for most people, for most sincere people who want to up their level to actually get to this stage, right? So the thing is that, can you actually manage a 5 or 6 figure stock portfolio without having any skills and experience? I personally do not recommend that. But at the same time also, I don't know anyone who actually did that. I do know a lot of people who try to make some quick money in the stock market, but the thing is that, do they have 5, 6, 7 figures in their stock portfolio? I don't think so lah. All right. So for me, I'm in the 6-figure category in terms of my stock portfolio. So I would say that without these skills and experience, right, quite hard lah. Quite hard to actually, how I say, quite hard to actually continue to manage, continue to sustain, continue to build your stock portfolio from there. Yeah. So therefore, if you want to actually go from 0 to 4 figures, let's say 10 to 20,000, then to 50,000, then to 100,000, and so on and so forth. If you want to go through this, if that is actually the journey that you desire, if that is actually your plan, you must actually have skills and experience. Otherwise, it is not very sustainable. At least that's from my point of view. Okay. So that's why I put a lot of emphasis on skills and experience. Okay. So guys, if you want to go big, you must make sure that you change your mindset from what most people are thinking, because what most people are thinking may not be very helpful when it comes to stock investing, to becoming smarter investors. Okay. So it is actually the minority that works better than the majority. Number 2 is that you need to pick up real skills and acquire experiences. I will go through them very soon. You need to also have a mindset and attitude of continuous learning. And last but not least, it is actually the investor that's more important than the investments. So therefore, focus on self-development to grow as an investor. Very important. So now we come to the highlight of this webinar session, whereby I'm going to share with you the 5 investing skills that everyone needs to level up in 2023 and beyond. So there are 5 skills. I'm going to go through the 5 skills very quickly. The first one is actually what I believe most people would have, and that one is actually literacy skills. Now, don't underestimate this skill, okay? Simply because literacy skills is actually quite important for investors to make better decisions, okay? Why is that so? This is because, number 1, for stocks in Bursa Malaysia, all the documents, all the annual reports that you see, the quarterly reports, the press releases, and some presentation slides, the websites of all these companies are presented in English, most of them. Okay, so the thing is that the advantage is that if today you are listening to this webinar, you learn very well in English, you communicate very well in English, you know how to read, you know how to write in English, that is an advantage by itself. Of course, most people don't realize it because for some of you guys, for even myself, for example, it seems that, hey, if you are very comfortable with English, English is your first language or maybe your second language, you don't think that it's an added advantage. But in truth, but truthfully, in Malaysia, as an investor, it is a huge advantage. Okay, because most of the official documents that you see in Bursa Malaysia is actually presented in English. Most of the investing books, okay, so like for example, you're going to read stuff from Warren Buffett is in English, Robert Kiyosaki is in English, Jim Rogers are in English. Most of them are written in English. So of course, if you can actually process this information, you can digest this kind of information in English, that will be an added advantage. Of course, most of the stock brokerage houses today, doesn't matter what you use, Maybank, CIMB Bank, Public Bank, or even Rakuten Trade, they're all in English. So if you know how to, so if you're quite good in English, very good. All right. You should actually capitalize on this. The most, how I say, but the funny thing is this, although maybe because people don't see this as an advantage, they say, oh, it's just natural, English, I know how to speak, you know how to speak, doesn't seem like an advantage. So, but then the thing is that a lot of people don't read. A lot of people don't actually look up the annual reports, start reading, start understanding the business fundamentals of a stock and all this kind of stuff. So when you don't do that, when you don't actually read all this stuff, then you kind of like have the advantage, but you didn't actually capitalize on it. So that is a bit on the PT side lah. So it's a bit kesian lah, I will say lah, right? So if you are well versed in English, make use of it. So that's skill set number one. But I guess most of you guys, if you are natural in English and all whatnot, so the first skill, which is literacy skill, shouldn't be a problem. So with that, we move on to the second skill, which is accounting skills. Now, accounting skills is actually super important to me as an investor. Okay. So a lot of people say, what are the skill sets should I learn as a stock investor? Should I learn how to use technical analysis tools? Should I learn how to interpret stock price charts? Should I learn how to, predict the market and all this kind of stuff? Should I learn all these things? But the thing is that actually sitting here as I speak right now, I don't really know how to use all these things lah. All right. I would say that my way of building portfolio, the one superpower or the one powerful asset, the powerful tool that I use to actually build my stock portfolio, right, is this. I learned accounting. Yep. And the purpose of learning accounting is very simple. With this skill set, from 900 stocks that are listed on Bursa Malaysia, with accounting skills, I can identify stocks that are financially solid. Financial solid means stocks that have delivered consistent growth in sales, profits, and operating cash flows. Financial solid also means stocks that have a strong balance sheet, low gearing, high current ratios, and so on and so forth. I can identify these stocks and put it in my watch list. And what happened is that I tend to avoid investing in a lot of stocks that have poor financials. So this, to me, this skill, accounting skill, is so important that I purposely learn how to, and I purposely upgrade my skills when it comes to this, so that I can actually just focus on the good ones and I just forget about the bad ones. Without this skill, everything seems to be a good stock. Okay, a lot of things seems to be a good stock. But after you have accounting skills, you kind of like have a real skill set that separate the good ones from the bad ones. Okay, so what is actually accounting skills? Now let me just simplify this so that you will understand. Because as much as people actually understand that, oh yeah, accounting skill is very important, but it seems to be very overwhelming. Well, technically speaking, it's actually not. Simply because accounting skills, right, is just a mastery of a few words only. Words like assets and liability, income and expenses and profits, and cash inflow and cash outflow. So as long as you know these 7 words, let me repeat again the 7 words. Assets and liabilities, income and expenses and profits, cash in, cash out. Once you know these 7 words, you are pretty, and that's it, That is actually the basics of accounting skills. And of course, these 7 words are presented in 3 statements as shown on the screen, which are as followed. Like, for example, I will purposely put a lot of time to study a stock's income statement because it tells me about the profitability of a stock. Balance sheet is about the financial stability of a stock, like debt levels and current ratio. The third one is actually cash flow statement. This is because I want to find stocks that have the ability to generate cash inflow from their business activities. So if I know all these things, then I can eliminate stocks that they are not profitable, not cash flow generating, high debt, almost bankrupt, and all this kind of stuff. All right. So that is actually the importance of accounting skills. Now, let's move on to the third one, which is valuation skills. Now, valuation skills is actually very important to me simply because after accounting skills. Accounting skills is actually skill set number 1. This is the most powerful skill set that I have. The next one will be valuation skill. So in terms of that valuation skill, what happens is that from that pool of financially solid stocks, not all of them are cheap. So I have to further segregate down which are the ones that are expensive and which are the ones which are cheap. So by using valuation skills, then I can actually identify which of these skill sets are, which of these stocks are actually fairly valued and undervalued, and which of these stocks are overvalued. So if the stocks are fairly valued and undervalued, I tend to invest in them, or I tend to consider investing in them. And if the stocks are overvalued, then I tend to avoid investing in them. Okay, so now we have 3 skill sets, which is literacy skills. So which means if English is not a problem, then no problem with that. Then you just focus on accounting skills and valuation skills. Okay, so these are the top three skills already. Now, skill set number 4 is this. Okay, this one take a little bit of time to explain, which is known as capital allocation skill. So this is actually a skill set whereby, how do I say, there are people who are actually worried that what if after I buy a stock, the stock price actually dropped by 50% or more. All right, they tend to actually worry about this. So because of this, that's where capital allocation skills come in to actually address this kind of issue. All right. So capital allocation skill, to put it simply, it is actually to answer this question: how much shares of a stock should I buy? How much shares of a stock should I invest in? So here I will offer 3 different types of measurement. All right. You can say that. So just go along with me when it comes to this. The first one is actually you can measure this. You can answer this question by calculating the percentage of a stock in proportion of a sector. So let's say, for example, you want to buy a bank stock, then you see how much bank stock that you have, then you calculate the percentage. That's one. The second one will be percentage of a stock in proportion of stock portfolio. The third one is proportion of a stock in proportion of your overall net worth. Now, how does it look like? Now, let's go through a simple case study. Then from there, you have a better picture or better idea on this. Okay, so this is how capital allocation skill works. So supposedly you want to actually invest in a stock, let's say a bank stock, X Berhad, and the amount of capital that you want to invest is 10,000 ringgit. Currently, your portfolio is valued at 90,000, and your overall net worth is 990,000. So, what does this $10,000 mean to you as an investor? So this is actually the impact. Now, before you invest, obviously you don't have X Berhad, so it's 0K. And let's assume that within your portfolio, within the sector, you don't have a bank stock at all. So since you don't have any bank stock, so here is 0K. So therefore you have nothing, which is 0%. Stock portfolio, since you have 90K worth of stocks, and obviously you haven't bought the stock, so it's 0%. And because you have no position in the stock, so therefore your percentage is still 0%. After you buy the stock, which is after you have invested 10K into the stock, so now you have one bank stock. So in your portfolio, you have the banking sector, but you only have one stock. So that stock will be 100%. So that stock is like 1 divided by 1, or in that sector, you have one stock and that's it. So that's why it's 100%. Now you invested 10,000, you have added into your own stock portfolio. So now your stock portfolio increased from 90K to 100K. And that 10% consists of 10% of your overall stock portfolio value. And in terms of net worth, you have invested another $10,000 into your stock portfolio. So your net worth kind of like increased to $1 million from 990,000. So therefore, that investment, the impact to your net worth is actually 1%. All right. So it's 1% to your net worth, 10% to your stock portfolio, and 100% if you want to measure it with your sector. Okay, so what happened if let's say if let's say the stock price actually dropped by 50% to 5,000? So the thing is that yes, the capital loss is actually 5,000, but if you look at it from overall net worth kind of perspective, you'll find that it is the 50% drop in stock price is 0.5% of your overall net worth. So that means it's actually not that significant lah, if you want to compare it with your overall net worth kind of basis. And if let's say the stock dropped by 50%, that $5,000 in capital loss is maybe 5% of your stock portfolio. Okay, so it is kind of like less significant. All right, it is kind of like less significant if it's actually measured with based on your overall stock portfolio. So that is actually the case lah. So with capital allocation skills, let's say just now after I explain, I kind of like illustrate with a case study, and let's say you couldn't get it, just remember this. This is what capital allocation skills can do to your portfolio. Number one, you kind of like limit the amount of investment into, let's say for example, you want to build a portfolio worth 100,000. You kind of like don't want to put it just into one stock. You kind of like want to separate out into multiple stocks, so that in case one of the stock is actually not, don't know lah, maybe it's a mistake or what, it doesn't impact your net worth that much. Okay, so that is actually one of the things why capital allocation is important. And the next thing would be, the second reason why capital allocation is that important is simply because, how would I say? Okay, the second reason why capital allocation is important is simply because you may want to actually reduce. You don't want to actually like, apart from diversification, I kind of like lost what I wanted to say, but all right, let's just keep it at just that lah. All right, sorry, I just kind of like have a loss of words. Let's just say that capital allocation is important so that you kind of like reduce your risk in terms of capital loss, and you just want to diversify. You just want to spread out your risk so that it doesn't impact your overall stock portfolio and your overall net worth as a whole. All right, now let's move on. The fifth one is actually portfolio management skills. Now the portfolio management skills is actually this. All right, the main purpose is actually to improve the overall fundamental quality of your stock portfolio. And you want to actually have a system to deal with short-term stock price movements. Okay, so this is actually where portfolio management skills come in. So number one is that, let's say for example, this is actually quite normal, where after you buy the stock price kind of like either crashes, falls and dips in stock prices. So when you do that, what happened is that, so this is what happened. A lot of people, they buy a stock, they expect it to go up. Okay, they don't really have an expectation of what if it drops. So when it drops, they kind of like react. Oh, my stock price has already dropped. Now what should I do? So that is what most people are thinking. But for us as smarter investors, the thing is that before the stock price drop, we already kind of like have a plan as to how we want to react to this situation. So which means, let's say a stock is actually priced at $10. If the stock price goes up, we have a plan for it. If the stock price goes down, we also have a plan for it. We don't wait for stock price to drop from $10 to $8 and say, oh, now it's at $8. What should I do next? So that is actually, so if you have that kind of issue, it shows that you lack portfolio management skills. Okay, so for one who has good portfolio management skill, so portfolio management skill is important for investor to actually react to this kind of situation. If it goes down to $8 or $7, should we cut loss? Should we hold on to it, or should we add more into our position? So that is actually what we do. Without this skill, you will kind of like panic. You will kind of like, oh, now my stock actually dropped by 20, 30%. What do I do? So if you don't want to actually panic, you don't want to actually kind of like react to. We don't want to actually be reactive to the stock price fall, then you need to have a plan. That's where portfolio management skills come in. And now we come to the last part, which is part number 5, how the 5 skills can help you invest better. Okay, so just now I talked about the 5 skills. The first one is literacy skills, but since all of you here, you guys are with me, I believe that you guys are fairly comfortable with English. So therefore, the thing is that I did not actually include skill number 1 over here. But let's see how each and every single of these skills can contribute to the success of building and managing a stock portfolio. So here we have 900 stocks in Bursa Malaysia. So the thing is that the first skill or the second skill that you may want to pick up is actually accounting skills. And with these skills, you may want to actually choose out of the 900 stocks, 30 stocks with the best financial strength. And then as for the 870 stocks, you can just forget it lah. All right, simply because the 30 stocks will be good enough for you to build a portfolio. But from these 30 stocks, some of them may be overvalued, some of them may be fairly valued, some of them may be undervalued. So what do? That's where skill number 3 comes in, which is valuation skills. They come in so that we can actually just narrow down our search to the 10 most undervalued stocks, which are good in terms of their financial strengths. Okay. As for the 20 overvalued stocks, we continue to keep them in the watch list, but we don't actually invest them for now because they are overvalued. So what we do is that we just keep them in our watch list so that in time, and surely there will come a time where these overvalued stocks become undervalued, then you may want to actually consider investing in them. So this is where valuation skills come in. Now, skill number 4 is actually about capital allocation skills. Okay, so this is where from these 10 skills, we pick the top 5 that you prefer to invest in, and we spread out the risks and we diversify. We build a diversified portfolio. So that's where capital allocation skills come in. And finally, skill number 5, after you buy them already, the stock price will go up, the stock price will come down. So the question is, we have a system to decide whether or not we should buy more, whether or not we should just continue to hold, and whether or not we should sell and cut loss. Admit that we have actually made a mistake from this investment. So this is actually where portfolio management skills come in. So as you can see, I use these 5 skills. Of course, literacy is one, but I use a combination of accounting, valuation, capital allocation, and portfolio management skills to really build a 6-figure portfolio. So if you know all these skills, I'm sure you can actually do that as well. So with that, thank you so much for listening. And I would like to pass back the control to Shane. And Shane, back to you, man. And of course, just now there's a slight blooper. So oops. So, apologies to that.
No worries. Thank you so much, Ian. So thanks for doing this 5 essential skills to build and manage a stock investment portfolio. So if you have any question to ask our speaker today, please write them at the Q&A box, not the chat box here, right there at the Q&A box. All right. So we can manage your questions effectively. Now, the first question is by Fastly. He asked, a lot of traders just jump in on the new listing for IPO, and some of the gurus recommended to buy the IPO and sell it off on the listing day. Is this a smart move to make fast money? Or we only buy the stocks that have more than a year of financial history? What do you think about this?
It depends lah. I mean to say, sometimes I do not know whether it's appropriate to say this in the Bursa Malaysia context lah. But since I just got myself married, then I like to relate stock investing as with, let's say, choosing a partner to get married lah. So it depends on whether or not. So it all depends why you get yourself a girlfriend or boyfriend lah. So like, for example, if you get yourself a girlfriend and boyfriend without the intention of getting married, then obviously the choice of your partner will be very different as compared to as compared to another person who is choosing a boyfriend and girlfriend to get married for the entirety of his and her lifetime lah. So for me, since I'm actually looking at partners, I'm looking, not partners, I'm looking for a spouse where I can spend the rest of my lifetime with her. So the thing is that the way I choose my spouse will be very different, no? All right. So back to this question. So if let's say you are just in for the short term, means to say you are just there to have fun lah. Then you have fun for 1 or 2 years, and then you move on to the next girlfriend or boyfriend. Then of course it's a different thing already lah. Okay, so that's my answer to that lah. As to is it a smart move, I would say it's not my move lah. I do not know whether is it smart or not smart lah, but it's not my thing. Because when I buy a stock, I tend to actually buy it and just keep it for many years, like more than 5 years. So I do not know how to make fast money. I'm like the wrong person to ask. But if you ask me whether or not the next one would be stocks that have more than a year, I would say more than 10 years of history would be a good idea lah. More than 5 or 10 years history would be ideal for me, not just 1 year.
Yeah, thanks for giving the analogy of relationship.
Mhm.
So I guess the strategy, the IPO strategy may work for traders, but not for long-term investor like Ian. So of course, so depending on your risk preference and your trading style or investing style, different skill and strategy work for different investor. The next question by Rauzana Adam is that could you possibly share what are the books that you read to help you to attain the investing skills on your initial stage that you mentioned earlier?
Wow, after so many webinar presentation, this is a very important question that I would love to answer. I mean to say, I got a lot of books. So of course, I started off with Rich Dad Poor Dad lah. That actually get me thinking about accounting skills and whatnot. So the thing is that specifically for stock investors, right? You can start off with a few local books lah. All right. So there are books like written. I mean, there are a few books from this publisher called Ace Premier. Like so there's a few titles like Once Upon a Time in Bursa, or there's a few Casey Chong books like something to do with dividend investing or value investing. You can actually grab that first. That's one of them. But for me, I mean to say, my first few books will be from how do I say, Adam Khoo, Pat Dorsey, and Buffettology. But Buffettology, I think you need to buy online because Malaysian bookstores, I don't think they have it already. They have other series of Warren Buffett books, but don't start with that first because it can be too overwhelming. So I think you buy online, Buffettology will be a good idea to start. I think the best one of the better books to start off with is Buffettology. Buy online.
All right, thanks Ian for sharing with us what books do you read. The next question is by Xin Hui. Can you recommend usually where can we find the reliable sources to further improve the 5 skills, especially skill number 2 and skill number 3?
Buffettology book. That will actually set up the foundation. That is actually a book on principles and foundation and foundation. So that is actually one. So after you read Buffettology, then you can actually start looking at other books that are relevant. So you can start looking at local books that will teach you about how do you read or how do you interpret financial statements better. Okay, you can go to online sources. Let's say, for example, just now I mentioned about current ratio. Oh, then you may think, oh, what is current ratio? I don't know. Then you just go Google out and you find current ratio. Or in fact, you can go to kclaw.com where I put a simple guide as to how do you read all this kind of stuff. You can just say Casey Lau and then financial statement, and then maybe something will pop up in the link, and then from there you can actually learn. That is actually pretty okay lah if you want to do self-study. But start off with the Buffettology book first. That book is it's kind of like the Bible for most value investors.
Thank you so much, Ian. The next question by Chang is that how do you evaluate if a stock is undervalued, fairly valued, or overvalued?
First, we need to determine the quality of the stock. Okay, so let's assume that the quality is there. The fundamental quality of the stock is pretty good. Then the next thing is for me, my way of evaluating a stock is through PE and dividend yields. So which means to say I use PE ratio a lot and I use dividend yields a lot. And I tend to compare it with its past historical PE and past historical PE and past historical dividend yields. And on top of that, if let's say, for example, we have a stock, let's say the fundamental quality of the stock is A plus, and then there's another stock where the fundamental quality is A minus. The PE ratio of A plus is, let's say, 20. For A minus is actually, let's say, 18. Then since the PE ratio is not that far away, I may go with A plus than A minus.
All right, thanks, Ian.
Mm-hmm.
The next question is by Oi. How do we find stocks with the potential to grow with your share skill sets?
Okay, so first and foremost, once you already got if you know, that's where literacy skills come in. So once you know how to read, you kind of like know how to, how would I say, you know how to read, you know what you're looking at when it comes to annual reports. That's actually the better way to actually find yourself a good growth stock. So you got to read. Otherwise, that's why literacy skills, when I prepared this slide that time, I do not know whether I should be preparing this slide because it seems too simple, like English, right? It's just that, it's just reading skills, if you know how to read, you know how to read lah. So the thing is that if you read, you can find a lot of good information of a stock. And that is how I find myself some stocks that are pretty good in their potential when it comes to business expansion and business growth. Yeah, it's a more efficient way. Of course, you can actually drive to the company office and you can ask the director stuff, but that's not efficient for me. So I rely on reading. Yeah, so it's good for us to read. And all this information are free. They are readily available at Perusahaan Malaysia website. So look no further. You can just go to Perusahaan Malaysia website and read all this kind of stuff. And that's how I personally find myself some really good deals in the stock market.
Thank you so much, Ian.
Mm-hmm.
Now, just now you mentioned about PE ratio. So Chang has a follow-up question is, what is a good PE ratio?
That one is actually quite subjective, but I would say anything above 50 is no good. It's like you pay 50 ringgit to earn $1. So what are your odds, right? So that's one law. Okay. Number two is that okay, I wouldn't say this but then as an investor these days, it's kind of a borderless market. It's not just in Malaysia. There's Singapore and there's US. It's normal. All right. So the thing is that when you benchmark it with every single company in the world, the top companies of the world today, and the top companies, they do not have a PE ratio of 50 or 60 or 100. But let's say their PE ratio is about 20 or 30, then anything lower than that can be considered. But the thing is that you may, like I said, I tend to use past historical PE ratio, past historical dividend yields, and compare it with their fundamentals in order to determine what is a good PE ratio. So it's not a straightforward answer like, 20 is a good PE ratio. It's not. It doesn't work that way. Yeah.
All right. Thanks, Ian, for sharing your perspective.
Mm-hmm.
The next question is, just now you talk about some books recommendation, right? So the follow-up question is are there any good platform for us to study the financial background of a company?
Of course, the thing is that I don't rely on them because because when you are building 6-7 figures of stock portfolio, you know that it is serious money already. You know that it is money that will impact your net worth already. It's not something that you play around with already, so it's like 6-figure. So the thing is that you want to read and go through the official documents, and these documents are readily available at Bursa Malaysia website, all the annual reports and stuff. So I don't go through platforms, I just read the annual reports, because we are dealing with bigger money than just a few $100 or $1,000 or $2,000, that kind of stuff. So I put a lot of emphasis on the source of the information. So therefore, no, I don't use platform. I just go straight to the source.
All right. Thank you so much, Ian, for sharing with us. You go straight to the source to rely on Bursa Malaysia platform to get the information. The next question by Maslan is that I think he's asking about your opinion. Ian, why are stocks like Capital A, which is financially distressed, but is still doing very well in terms of the share price and has rallied? So what is your view?
I don't know, because the thing is that that's where you want to speculate. That's where I mean to say, I don't know lah. I mean to say, okay, so because of my way, I have a shortcoming as well lah. The shortcoming is that because I tend to focus only on the financially solid ones, then I tend to avoid the ones that are the ones that are financially stressed, right? So in terms of a Capital A, it depends lah, okay? It depends on what you want to look for in a stock lah. So that's why I say that actually, let me just go back to the mass market. So that's what I say, like when a stock now rallies up like 56%, suddenly everyone wants to get a piece of the cake. Because why? Oh, suddenly some things have turned around, gained 56%, but financially it's not so good. Then how? That's how most people make decisions. They base on this lah. So the purpose of the webinar today, although there's a little bit of blunder from my side because I suddenly lost a few words. But anyway, the purpose is to shift, to actually introduce a different way of thinking, whereby I don't think like that. I don't think in terms of that. I don't make decisions based on this. I just want to review a world where most of the investors, they tend to focus on the ones that have already been working and will continue to expand what they are. They will tend to focus on something that's working, and a company that is taking something that is working and expand it to the next level. So that is what we are focusing on. We are focusing on the winners, and we are not focusing on the ones that have financial stress, So that is actually the thing lah. So we don't try to speculate why Capital A has rallied by 56% lah, because that is actually not really our concern lah. Maybe a trader or speculator will be more concerned about that, but if you ask me, I won't have an answer lah. That's where I know that the company fundamentals and the emotional decisions made by most people can be two separate things. So if you know how to separate them, then you might actually find good bargains in the stock market lah. And of course, on the flip side, once you get yourself a good bargain in the stock market, and when your stock happen to rally up like this without any sort of justification or reason, then that is your money lah. That is our money to actually makan lah. That's how we realize huge capital gains if that happens.
All right. Thanks, Ian, for sharing your opinion. The
Mhm.
next question is asked by MK. How do you calculate the fair value for IGB REIT?
Every REIT got a property valuation report. So they will give you a property valuation report. Then from there, you can minus off their liability. And then from there, that's that. So that is actually one way to calculate the fair value of IGB REIT. But the thing is that for most people who invest in a REIT, what is actually more important is the income productivity of the REIT, which is the rental income. So typically, what is actually more important for a REIT is how much distribution yield are you actually getting from this REIT. So that is actually more of a pertinent question. But if you want to calculate the fair value of a REIT, so as mentioned, that's how you just take the property valuation minus off all the debt, and that's it. It's quite straightforward.
Thanks, Ian.
Mm-hmm.
Now, Ian, just now you mentioned about how do you combine the 5 skills to navigate to pick a winning stocks. So the question by Ayman is that, do we need to go through the stock one by one in the market? There are 900 companies, right?
Just start with the familiar ones. Actually, most of the 900 stocks, right? Maybe 50 of the stocks, you might actually come across them as a consumer yourself, as a client, as someone who has actually used their product, maybe are familiar with the brands that they have. Then you start off with the 50. Then that will save you a lot of time. Then you don't need to go through the 900 stocks. So just go through 50. But a lot of investors may not even want to go through 50. So then go through 30. And some people may not even want to go through 1 because it's too troublesome, right? Who wants to read these days? Especially when we are living in a world where people actually receive information and they want it in 30 seconds or 1 minute, then how? So how do you actually decide on the investment with a 30-second TikTok video? So it's so that's the world we are living. And I would say that people who are more diligent can win this game. I'm not saying that it will be quick, but I would say that it will be more sustainable. So go through 30 stocks. So it's less than half of the 900 stocks, right? So just go through 30 stocks and start with the 10 that is of the best.
I think a good start could be start from the industry that you're familiar with. For example, if you're an engineer in the oil and gas industry, then you can start with some stocks in oil and gas that you're familiar. Or if you're in a banking, then you can start with banking. If you start in a plantation, then you can start with plantation stocks. Right? Start with industry that you're familiar with, because Warren Buffett also said this, invest within your circle of competence. So that's where how you can begin. Take the first step. All right.
Yeah.
So let's do the one last question by Norman. Have you combined speculation and investment in one stock? What is your opinion about this?
Eventually, you'll end up as a speculator. So, so no. So no, because the thing is that so there are people who introduce themselves, I'm a trader investor. Eventually, they will tell you about trading more than investor. Why? Because at the end of the day, it all depends on what you are focusing on. If you are focusing on money, you want to get money, quick money and all this kind of stuff, if you know how to, if you kind of like say, oh, I know how to take $10,000 and buy a stock, and then it will goes up to $20,000 and sell it off for a $10,000 profit, you will eventually do that. Because investing, I would say it's for most people, it can be a slower game, but it is a game, but it is a way where how would I say, for most people who go into 5, 6 or 7 figures, that is actually the road that they will take, because everything builds progressively. 10,000 per 10,000, step by step, just continue to do this, continue to just work on the system, continue to just go through the process for years. That's how you get your 6-7 figures in your stock portfolio. So the answer is no. If you want to speculate, that is actually a personal choice. But if you really want to build a 6-figure portfolio, then better you eliminate the need to speculate lah. If you are that itchy, you still want to speculate, just allocate some money for you to have fun lah.
All right, thanks Ian for doing this webinar for us.
Yep, thank you so much.
So ladies and gentlemen, you just heard from the content creator on kclaw.com, who is Mr.